Hello everyone. Respected members and dear friends, a very good afternoon. I hope you all had a refreshing break. I am CA Nishan Kabra, welcoming you back to the National Conference on Capital Markets. We will be now proceeding for the third session of the day on a very interesting topic, Quant Investing in India, Strategies for Sustainable Alpha Generation. I kindly request CA Chetan Jagatia to accompany our esteemed faculty for the session, CA Siddhrath Vora, to the dais. Please give a huge round of applause, everyone. I request CA Chetan Jagatia to present our faculty of the day with a token of appreciation, please.
Yes, sir.
Prabhudas Leeladhar PMS. He is one of the youngest portfolio manager in India. He is also executive director at Prabhudas Leeladhar. Siddharth has built and leads a diverse team of experts including chartered accountants, CFAs, statisticians and so on. Under his leadership, his team has conceptualized and developed a multi-asset dynamic portfolio. This is India's first multi-asset PMS that deploys quantitative technology for asset allocation. His expert insights and perspectives are often cited in leading business publications and channels like CNBC, ET Now, Mint Business Standard, and so on. Siddharth's academic background is also impressive. He is a chartered accountant, CFA, and he has also completed MSc in Management for Business Excellence with a double diploma in World Politics from University of Warwick. He has also completed programs from renowned institutions such as Harvard, the London School of Economics, and Cornell. Now may I please invite Siddharthji to take over the session further.
So good afternoon, everyone. Thank you so much for taking the time out on a Sunday and coming here. And I think we're going to have a very, very interesting session. I think all the previous sessions that have happened so far, everybody is only focusing on one key topic, how to make more money from the markets, whether via fundamentals, via technicals or other methods. Everybody is focusing on how to make more money from the markets. And today I'm also going to talk about the same topic, but present a very different perspective on the same. Before I begin my session, I want to understand how many of you all know who is the most successful investor or trader in the history of time. There's only one person actually. I don't know how many people know about that person. Rakesh Jhunjhunwala is your, okay, then? Yes, that's right. So the most successful person on planet Earth is actually somebody called the legendary Mr. Jim Simons. He just passed away 1 month back. He has a track record of generating 66% CAGR for 35 years in a row. And he is actually the world's most successful fund manager, investor, etc. But he's a very private person, so nobody really talks about him as much as they talk about more popular figures like Warren Buffett or Charlie Munger or Peter Lynch or Philip Fisher. So Jim Simons is actually known as the world's father of quant or the quant king. So what he did for the world was taught everyone how we can use rules, machines, data to actually make investment decisions as opposed to humans making those decisions on their own. So that is the gift of Jim Simons to the world, and obviously we also as India have to adopt and upgrade and move to more sophisticated methods of managing money. So what we've, before I explain you what quant is, I would actually like to take a few basic examples of how in our daily lives we are using some kind of quant in some or the other way. So I think let's understand what we did with calculators, right? So 100 years back, people used to do mental math and used to write on paper. Then came the calculator. Then came advanced calculators. Then came Tally and Excel. Now the world is moved to Python and now ChatGPT. So there is a huge evolution of how we used to do something, say, 100 years back in a primitive and unsophisticated way. and now we do it in a very, very sophisticated way. As of now, whoever has used ChatGPT, even if you give a complex 50-line calculation, it'll perform it in 10 seconds. That is the power of machines, and that is the power of computation. Similarly, another example is in US, in some parts of US and China, people actually have driverless cars, which means they don't want a driver to drive and make decisions on the roads. I think India is still a little far away from there, thanks to the way our people drive, the way our roads are, the way our signals are broken. But in more organized, well-set economies with more rules, a tighter law, driverless cars can still be a reality. So the idea is, I always say this to everyone in my office and all my team members, right? That 25 years back, in any part of India, if you wanted to go from place A to place B, you had to know the road. And if you didn't know the road, you had to ask people around of how to get there. As of today, I don't think anybody who is 30 or below even bothers to remember roads because they have Google Maps. Google Maps actually guides you to go from one place to another without you having to make that decision, you having to take that stress. So pretty much what Google Maps did to navigation, Quant holds the potential to do to investing. And that is something we're going to decode and understand in more depth today. So the topic I'm going to be talking about today is quant investing in India to understand strategies that can help you generate sustainable alpha. Now there are 3-4 keywords here. First is quant, second is India, third is alpha, and fourth is sustainable. So we'll understand what quant is, we'll understand what alpha is. Alpha is basically outperformance, beating the benchmark. That is what alpha is. And you can beat the benchmark on the upside and the downside. Markets are up 25%, your portfolio is up 50%, you've generated alpha. Markets are down 50%, your portfolio is down 25%, again you have generated alpha. So as an investor, the only thing you should be seeking is not returns, it's alpha. Returns can be made in many ways, but alpha is hard to make. The other thing about alpha is you can't have a method that can help you make alpha at one point of time or as a one-off. It needs to be repeatable. It needs to be sustainable. And that is why we are going to understand how we can use quant to make alpha that is sustainable or repeatable in nature. And that is the whole essence of long-term sustainable investing. And I think a big debate around the world has been going on, we are in the era of man versus machine. Everybody is talking about man versus machine. So we at PL, we strongly believe that we are actually not in an era of man versus machine, but we are actually in an era of man with machine, which means when you get the combined capabilities of human intelligence minus all the emotions that the human brings, plus all the rigor, discipline, multitasking, data processing capabilities of a machine, that is a deadly combination. Because in investing, you actually need to understand markets, you need to understand how research works, you need wisdom around the whole subject of investing, that only a human possesses. But the human also comes with a baggage of lot of emotions of greed and fear, which causes them to make tremendous amounts of mistake. So our entire idea is to get rid of the emotions, but still retain the intelligence. And with that, I'm going to tell you how in an era of man versus machine, the combination of man with machine can actually bolt your portfolios to a new level. So before we start, I'll just give you all a quick glimpse of live performance that we've been able to deliver in the last 1 year. So we actually run a PMS strategy called Aqua, which is literally built on all the principles I'm going to talk about today. In the last 1 year, we've delivered close to 77.5% absolute returns, which is an outperformance of 35% versus BSE 500 and 48% versus Nifty 50. So this is the whole concept we're going to talk about, right? We need a strategy to make alpha, but alpha that can be repeated again in the future. So let's understand the basic process of how quant really works, right? So I usually give this example that assume there is one guy who's a master chef, but he uses his experience to cook all the time. And there is another guy who's not a master chef, but he basically follows a recipe to try to create the same dish. So over the long term, what happens is, the guy who uses his experience all the time cannot give you the same output or the same consistency or the same flavors. But the person who's following a process, who's following a recipe, they will most likely be able to create a similar level of output over and over again. So the difference between quant and active is also this. The active investor is trying to use his brain, he's trying to use what he's hearing from people, he's trying to listen to tips, he's trying to read the news, he's trying to look at charts, and he's also using his emotions of greed and fear to make decisions. Whereas a quant is actually using only the set of well-defined rules, processes, systems, and data without any emotions to make the same investment decisions. And over the years, we can prove with data that a quant system of managing money is more sustainable than an active system of managing money. So the process is very simple. You first need to define what is the input that goes into the model, what is the data that the model will eat, what are the rules and processes that we define as fund manager or as head of strategy, how will the output be generated. The output also is very simple, right? Everybody who's in the markets wants to answer a very few set of questions. Which stock to buy, which sector to invest in, how much to invest in a particular sector, what price to enter, when to exit, how much to allocate to a particular stock, when to create cash in the portfolio. So the answers are simple, but the method of reaching those answers are very, very clinical and scientific. Just to give you guys an idea of what's happening around the world, right? So in India, only 1%, a mere 1% of money is managed quantitatively. In America, that number is at 35% today. But if you look at what happened in 1989, you can clearly see here that 89% of all the money in US was managed actively. But in 2023, only 26%. So 89 has become 26. Only 26% of the money is now managed actively. Which is showing what? Two things. First, the preference of investors is changing. And why is the preference changing? Because investors also chase performance. If quant funds are performing better, obviously they will move out of active and give it to quant. So in a simple way, the way to understand and interpret this data is that in 1989, 90% of the people thought that a human can beat the markets consistently. But in 2023, because of data, because of talent, because of technology, now people have realized that one human can't consistently beat the markets, might as well give money to systems, to processes rather than people. And that is the whole paradigm shift that's happened in the world in the last 30 odd years. And the beauty is India is also catching up, and we are making a lot of effort to make quant also accessible to all investors in India. And a quick stat here is, in the last 5 years, 100% of all the quantitatively managed schemes in India have actually beaten the benchmark. But only 47% of all the actively managed schemes in India have beaten the benchmark. So what will happen? Investors obviously will see this data over and over again, and they will start shifting their money from underperforming strategies to outperforming strategies. And that is the reason that over the last decade, we've seen a 340x growth in quant assets in India. But don't get too excited because the base is very small. In a 50 lakh crore industry, we're not barely managing even 90,000 crores. So it's a very, very small number. But over the years, this is going to go up because of performance, process, technology, etc. What is very important to understand, I'll just give you guys a brief background about the company that I'm representing as well. So we are from Prabhudas Leeladhar, now known as PL Capital. We've been in the capital markets business for the last 8 decades, since 1944. We operate under 3-4 main businesses. One is wealth management, which includes our own distribution, broking, advisory, and NBFC. The second piece is the asset management. And the third piece is the capital markets business, where we focus on institutional equities and investment banking. So these are the three main businesses that we operate. And today I'm representing the asset management vertical of Prabhudas Leeladhar. So what we did very differently is, so we had an active asset management vertical for the last 10, 12 years. When I took over the business in 2018, we decided that now we got to pivot to Quant. We got to shut down active and move to Quant. And in 2021, we finally, made a team of quants. We developed our strategies, tested our strategies, and then decided to completely shut off active money management and move to a pure play quant asset manager. And I'm proud to say that as of today, we are one of the only few pioneering quantitative asset managers in India, bringing differentiated and exclusive strategies for all investors. What we've done over the last few years is, instead of relying on fund managers who come in and then leave the organization over different parts of their career, we decided we will rely on processes that we own, that we create, because that is our intellectual property and that is our IP. If we manage investors' money using IP as opposed to using people who use their discretion, judgment, experience, we will have an organization that is more sustainable in the future. So we've obviously, brought in global experts like Dr. Punita Kumar Sinha, Dr. Swapnil Pawar, a lot of experts from around the world in the field of quant to actually help us build this entire setup. And now we have a team of 22 quant analysts, pretty much one of the largest teams in India on the quant side. Now, with that background having been covered, let us understand what should a quant strategy help you do. It should help you take 6 critical decisions of your portfolio, and this should be coming from a set of rules. So again, this is going back to the main topic we're trying to talk about today, right? How to generate alpha using quant. So this is actually the starting point of that. So the 6 decisions include, first is you need a methodology to decide how to allocate to which asset at which point of the market cycle. When to be in equities, when to be in debt, when to be in gold. You need to understand that. You need a set of rules. You can't always be in equity. You can't always be in gold. And just to give you a quick idea of that, I think if you look at, one second. Yeah, if you look at this data, it's very clear, right? That sometimes your liquid fund is the best performing asset. Sometimes large cap is very good. Mid cap is very good, but none of these assets perform well across market cycles. The color keeps changing. And to get a strategy that helps you navigate the ups and downs of market cycle, you actually need to be dynamic in your asset allocation rather than a static approach. The other thing which is very important is deciding when to be in mid caps, when to be in small caps, when to be in large caps. You can't have a one-size-fits-all approach where across the years you'll always be a small cap investor or a mid cap investor, because these assets operate in cycles and we need a method to ensure that we can get in and out of these at the right time of the market cycle. The third decision, the most critical decision, is the sector rotation decision. So we at PL and using Quant don't believe that you can actually buy and hold a sector for 5 years or 10 years. The way to actually make money in markets is following sector rotation. Sector rotation basically tells you which sectors to allocate when and which sectors to stay out of. Because when you make alpha, you're making alpha in 2 ways. First, the sectors that I have eliminated, say private banks or FMCG or IT, if these are not in my portfolio, but they are in the benchmark and they are underperforming, then my portfolio will earn alpha from elimination. But if I'm in capital goods, defense, railways, automobiles, and these sectors are outperforming, then I make alpha by selection. So using sectors to make alpha is very critical, because you can make alpha both ways, by elimination and by selection. The fourth point is actually one of the most underrated points in India. It talks about investing styles. So what that tells you is that people come with a very strong style bias, like growth investing, quality investing, value investing, momentum investing. In Quant, what we believe is You can't have one style that works across market cycles. For 3 years, value will do well. Then for the previous 2 years, quality and growth did very well. Then momentum has done very well. So you can't have an approach and classify yourself as one of these investors. You have to be able to change and adapt based on the market cycles. The last two things are, of course, managing your portfolio beta. In a bull market, take more risk. In a bear market, reduce your risk by reducing your portfolio's beta. And finally, have a holistic method of security selection. Don't use only growth, only momentum, only quality as a basis of selection. We believe that a multi-factor approach, which means combining quality, growth, valuation, volatility, momentum, sector, risk analytics, liquidity analytics. When you combine all of this together and then select stocks, you have a strategy that is more robust, that is more comprehensive in their nature. Now, a quick glimpse. Just focus on the colors here. This is just to demonstrate not what we are saying, but what the market has actually done. So over the last 15, 18 years, we can see that the colors are changing very frequently. The colors basically represent that the top line here is actually the line of the best performing sector, and the bottom line here is actually the line of the worst performing sector. And what is very evident is that the best and worst keep changing very, very drastically across market cycles. So if you do not rotate your sectors, there is no possibility that you will have consistent alpha. You might make 100% returns in 1 year, be down 50% the next year, again 70% up, again 80% down. We don't want a journey like that. We actually want a strategy that can navigate the ups and downs using the principle of sector rotation. The same also applies to the whole philosophy of using styles. So just to give you an example, we have a lot of people who who travel all around the world, but they cannot speak the language of the place they go to, right? So if you go to Russia tomorrow, it's not like you can speak in Russian. Or if you go to Italy, you can't suddenly start speaking in Italian. Because your language is inherent to you. You can't change it. So what can you do? Usually when I travel to countries that don't understand English well, we use something called Google Translate. Google Translate means you type in English and you press translate to Italian, it translates to Italian and shows it to the person in front of you. Similarly, in the world of investing, our investment style is very, very inherent to us and we can't change it. But because Google Translate helps you bridge this gap, in the world of investing, Quant helps you bridge this gap and enables you to change your investing style from value to growth, growth to quality, quality to momentum based on the market cycle that we are in. And again, if you look at the colors here, it's very, very evident that no one investment style continues to perform across cycles. And this is the same representation to show you the sharp peaks and troughs of any one individual style. So if you look at value, for example, you can see that so many times it's at the top. But then also every time it's at the top, in the next 2 years, it makes a sharp correction. So very, very important to understand, because even quality goes through the same, even momentum goes through the same. In all these 6 charts, there's only one which is little more stable. This one, the first one here. I don't know if you can see my cursor here. One second. Yeah, the first one here, this is more of a stable chart. The reason of this stability is simply we don't use a single style to invest. We use a combination of styles to invest. We call it a multi-factor approach. Now, let us actually decode the strategy that we use to classify markets in 3 risk zones, and based on the risk zone we are in, construct the portfolio accordingly. So the first zone is the risk on zone. We call it the highway. Highway means it's a clean road. There are no cars. The road is smooth. You can actually accelerate your car at a high speed. The agenda here is make more money, make more returns, stay focused on upside. Don't get deviated by volatility. Stay focused on capturing upside returns. Teji, paisa banao, bahut sara paisa banao. इसमें how do we really focus? First is we have to make sure bulk of our portfolio is allocated to equities in a cycle like this. No need for debt. Within equities, try to ensure you have a healthy proportion of mid and small cap. Within that, ensure that you have cyclical sectors dominating your portfolio. Because when you are in an up cycle, or the cycle is changing from down to up, you're basically seeing that stocks that have underperformed in the previous cycle, which we call as cyclical stocks, actually have a much higher operating leverage. Their profits change the fastest, their ROE changes the fastest, and hence the multiple re-rating is the fastest in these kind of stocks. So it gives you high alpha. Your portfolio beta should be high, means market karta vadhare risk levanu chhe. And the factors that dominate these cycles are technical and sentiment driven factors. The second zone is basically when your highway is ending and you don't know what lies ahead. Is there another highway, or is there a valley, or is there a ghat? You don't know. You can't see clearly. This is something we call the risk transition zone. The focus here should shift from only generating returns to risk adjusted returns. Means balance returns and risk both. This is the time when large caps start playing an important role in your portfolio. Along with cyclicals, you also need structural growth sectors in your portfolio. The idea is portfolio beta has to reduce and shift focus from technicals, shift focus from sentiment to fundamentals and valuation. And the final zone, the risk off zone, this is the scariest zone. I don't think since COVID, anybody who's sitting here has actually seen that also. But it can come in the future like it has come in the past, so be prepared. The focus here completely shifts from returns or risk-adjusted returns to only risk. Reduce volatility, reduce drawdowns, reduce your correction in your portfolio, and only focus on managing downside risk. Over here, cash also comes into your portfolio and plays a very, very important role. The focus equity asset is the large cap group of stocks, and you should move into structural, secular, defensive sectors. Portfolio beta has to be significantly lower than the market, and now focus is on volatility, macros, and fundamentals. So it's a completely different way to look at this regime. Now what we have designed actually is called Aqua, adaptive, quantitative, unbiased alpha. So what is the agenda of a strategy like this, right? Aqua is actually inspired by water itself. So the way water can change its form, it can become ice cubes or steam or water, or its color. If you put haldi, it will become yellow. If you put coffee, it will become brown. Or it can change its shape based on the container you put it in. We also need a strategy that can change its shape, that can change its style, that can change its form across market cycles. And this is only possible to do using machines or quantitatively. So actually, Aqua has taken inspiration from water, and the three zones I explained you, that is exactly how the strategy is running. It first identifies the regime and then constructs the portfolio accordingly. This is a quick glimpse of how investing styles change in different years. So I've just taken, say, 2007 to 2024. Yellow is representing when market was in a value cycle. Blue is representing when market was in a growth cycle. Orange is representing that market was in a quality cycle. And dark blue is representing that market was in a momentum cycle. What is very important is across years, these cycles and styles keep changing. Your portfolio needs to be able to change like this. We'll talk a little bit more about risk management as well. I think risk management is very, very critical in markets for your own portfolios, or whether you're evaluating portfolios of other funds as well. So we look at risk in two ways. First is all the known risks. Second is all the unknown risks. For the known risks, we believe that you need a preventive method of managing risk. Preventive means, let us look at all of us and how our health really works, right? Unless you fall very, very sick, big disease, big infection, You won't be going to a doctor won't be telling you what's happened to you, and he'll not be giving you antibiotics. Are you going to be taking antibiotics on a daily basis to ensure that you don't fall sick? That's not something anybody would do, right? You'll probably die in a year if you do that. So similar to antibiotics, let us look at the other side, which is vitamins. We can take vitamins daily, they don't have side effects, and the vitamins help us to build immunity and to ensure that we don't fall sick too often. So this whole concept of vitamins and antibiotics can be actually used in the markets as well. The moment we take vitamins, we are saying, okay, I know if I don't do the right things, I can fall sick. So I have to have preventive measures. So what are some basic risks that we know from before? First is liquidity risk. What is liquidity risk? Buying illiquid stocks. What happens when you buy illiquid stocks? If you buy them, you will only be controlling the price. I'm talking about at a fund level, right? We're managing public money. So when we buy stocks, we only are pushing the prices up. When we sell stocks, we are breaking the price. So how to answer this question? We don't want to invest in stocks that are illiquid. So from the top 500 stocks by market cap, we eliminate 100 stocks based on liquidity filters. This is my vitamin L, vitamin liquidity. Second is corporate governance of fundamentals. We eliminate 100 stocks based on fundamental red flags from the top 500 by market cap. Why do we do this? Because we don't want stocks in our portfolio with lot of evident red flags. So that makes my investment universe only top 300 by liquidity and fundamentals. The other thing I know from before, known risk, is diversification risk. If I run a 5 stock or a 10 stock portfolio, I might make money in a certain cycle, but I might lose a lot of money if a few of those stocks go wrong. So I need an optimally diversified portfolio. So in Aqua, we run a 25 to 30 stock portfolio, equal weighted. This is also a principle of risk management. How many stocks and how much weightage to each stock. This is how we preventively, precautiously manage risk in our strategy. The other is timing and opportunity risk. If I come with a bias on the table that I will buy and hold stocks for 10 years, 5 years, etc., or I will hold it only for 1 week, both the cases are wrong. Because what that tells me is, I've come to the table with a predefined view and I'm not willing to look at data and change if the data tells me to do so. And that is why in Aqua, we use a 2-month rebalance cycle. So the idea is, every time we rebalance the portfolio in 2 months, we actually realign the portfolio to the market reality. We could make changes in our sector holdings, we could make changes in some stocks, we could ride the winners and book partial profits in them, and we could exit the laggards without any emotions. So it's very important to know that there are some risks that you can predict from before, which are known. You need to ensure that you prevent them. Then there is another risk, the infection. You can't predict it. And because you can't predict it, there is nothing you can do in advance. And that is why, to deal with infections, we need to respond to market. Not predict, but respond. So how do we respond to the changes in market risk? First is, if there is a big global systemic event and equity as an asset class is going to go out of favor, first create cash in your portfolio. In Aqua, we create cash up to 50%. Second is your size risk, market risk. Mid caps and small caps are overvalued. They might go out of favor soon. Till they go out of favor, they've actually not gone out of favor. So we wait for confirmation. Once we get the confirmation, we change the portfolio mix, tilt from mid and small to large caps. So till December, our portfolio had close to 25% in large caps, 75% in mid and small caps. January onwards, gradually, now portfolio is moved to 45-50% large caps and 45-50% mid cap. So large cap is doubled. Small caps and mid caps have reduced because we believe we are in the risk transition phase right now. Risk on was till December. Post December, we've been in risk transition. The other risk that we see is the sector risk. Some regulation has changed. The pricing environment has changed. The demand environment has changed. The costs have gone up. Whatever it is, there could be some major changes in the different sectors. We review our portfolio every 2 months to see if we need to realign our sectors or no. This keeps us relevant to the market. The other thing is that for 1 year, last 1 year, we've been in a value and momentum tilt in the markets. Gradually, we are getting evidence that we could be moving into a quality cycle or a quality tilt. So my portfolio will be changing its color. Very, very important, almost impossible to do manually. We process more than 1,000 indicators to actually detect that the styles are changing, sectors are changing, etc. So the big point here is, if you look at the last 10 years in India also, every fund house comes with a particular style bias. There is a style that they like to follow, like value or quality. But say over the last 3 years, all the funds that they followed a value style, they do very well. But all the funds that were following a quality style, they did very badly. None of them were able to change to each other. In the previous 5 years, like 3 years ago, the previous 5 years, all the quality and growth funds did very well. Value as a style underperformed tremendously for 5 years. So do we want a strategy that will work like this? That 5 years underperform, 3 years super performance, then again 2 years underperformance? No. We want a strategy that is sustainable. And that is why we say that we keep evaluating which is the prevalent style in the market, and basis that we change it. Similarly, for the risk environment and for the stocks in our portfolio, very important to know that we start with an equal weight, say 4% per stock max weight. If that stock goes up very high, we actually book it and bring it down to 4%. So to give you guys a few examples, right? Mazgaon Dock, Cochin Shipyard, Hindustan Aeronautics, BEL, Power Finance Corporation, REC, BSE. These have been some of the stocks where we made more than 100% return in each stock, which means if I start with 4, it becomes 6, 7, 8 based on how my entire portfolio has changed. So what do we do at the end of every 2 months? We actually trim and book that extra profit and bring the weight down to 4. This gives me 2 advantages. First is I have booked some profit from a winning idea. Second is I've brought my risk per stock back to acceptable levels. If I let that ride and that stock becomes 20% of my portfolio, and after that it corrects 50%, I'm actually losing 10% of my capital. As opposed to a 4% stock correcting 50%, I'm losing 2% of my capital. And that is why managing risk at a security level is also very, very important. And now let's look at how we actually select the stocks, how we actually construct the portfolio. So we use something called the 6S framework. I think this is a very, very powerful framework for you guys also to use in your own investing. When you guys select a stock, when you guys make an investment decision, please try to have this mental framework available for you all, right? So we look at So we look at 6 things here, but we look at it in 2 different layers. First is the top-down layer. Second is the bottom-up layer. The top-down layer tells me they have to answer 3 questions. Which investment style should I use now? Which sector should I invest a lot in, and which sector should I completely be out of? And third is how much risk should I take? So my top-down layer will tell me these 3 things. But my bottom-up layer will tell me which stocks to buy. How will it tell me that? We rate every security in the top 500 universe of India on its fundamental score, technical score, valuation score. Then we ensure that if my top-down model is telling me that right now valuations is the dominant factor, we give more weight to value to select. If fundamental is the dominant factor, we give more weight to fundamentals to select. And if we are in a bull market and technical is the dominating factor, we give more importance to technicals to select the stock. So again, let me explain how this is really working, right? Fundamentals, valuations and technicals, all 3 are used in selecting stock, but the weights for them are not equal across cycles. In a certain cycle, fundamentals are given more weight, in another cycle valuations, and in another cycle technicals. So who will decide how much weight to give to these 3 pillars in which cycle. The top-down layer actually decides that. So the top-down layer looks at markets from a very macro perspective to identify sectors, style, risk. Once the top-down layer is given its output, then the bottom-up layer is triggered. So when you guys look at stocks, at least look at these six things. First is, are the fundamentals of the company I am investing better than its own past, better than its peer set? Very important to know. Secondly, are the valuations cheaper than the peer set I'm looking at? Are the technical factors like volatility and momentum stronger than the peer set I'm looking at? This is easy to do even on the apps that are available today. The other things that you all need to look at is this stock from the sector I want to invest in, or is this stock from the sector that I want to avoid? We don't invest in stocks that are not from the sectors we want to invest in. So if a stock is very good on its own, but that sector is not coming in my top 10, top 15 sectors, we will avoid that stock, because understanding the power of sector rotation, it improves return by 74%, which means one strategy looks at sectors to make stock decisions, other strategy looks at stocks alone on its own. The difference between the two is 73%, which means if you invest in the right sector at the right time and exit that sector at the right time, your returns will be 73% better. Similarly, very important to understand, don't look at valuation or fundamentals on an absolute basis. Look at it on a relative basis, because the whole market is a mechanism of relative discounting, which means, let's take two basic examples that I think every chartered accountant in the forum would know. First is ROE, or return on equity. Second is P, or price to earnings multiple. Usually people say that a stock with a P below 15 is a cheap stock, and a stock with an ROE more than 15 is a good quality stock. I completely don't buy this logic. The reason is, every time you look at ROE, you need to look at it from all the three lenses. What is the peer group ROE? What is the historic ROE of that company? So a 35% ROE company going to 15% is not good, but a 10% ROE company going to 15% is very good. So you should look at it differently. Similarly, if I am operating in a sector where most companies are doing 30% plus ROE and I am at 20%, so on its own 20 is higher than 15, so that is very good, but it's still less than my peer set. So I should be getting negative marks for that. Same for PE. When the whole market is at a 35 ka PE, I can't say that I will find stocks below 15 PE. Stocks below 25 PE could also be considered cheap. So it is very, very important to look at this from a relative lens. Finally, what we need to understand is how all of this comes together and what kind of performance does this create for us. So in the last 1 year, this strategy, we are managing close to 350 crores in this strategy, has generated a return of 78.41%. That is an alpha of 51% versus Nifty and 36% versus BSE. Now let us see how this return is staggered around the different time periods. So we've had 4 quarters. We've outperformed and delivered positive returns in all 4 quarters. We've had 6 rebalances of 2 months each in the last 1 year. Leaving one, we've done very well in all the other 5. And we've had 12 months. So 10 out of 12 months we've outperformed or delivered positive returns. Only 2 months we've underperformed. So that's a very good hit ratio. That's an 83% hit ratio. So the idea is, we don't want a strategy that will make returns in 1 quarter, say 30-40%, and next 3 quarters it's failing. Or 1 month it'll do very well and next few months it'll fail. We want consistency. We want repeatability. So the whole idea in this visual is telling you that the more green color that you see, that much more your strategy is consistent. That much more it is repeatable. And the idea here is, in 6 rebalances, we've only got 1 wrong by a margin of 2%. Every other rebalance, we made significant alpha. Some of the big winners that we've had in our portfolio, obviously don't take screenshots here because we've exited these stocks already. So no point in, this is just the winners that we've had in the last 1 year. So of Cochin Shipyard, we made 400% returns, BSC 225, IRCON 167, Schneider Electric 158. And if you look at the, sort of names we operate in, right? We made money from Tata Motors, M&M, Hindustan Aeronautics. These are literally the top 300 companies of India, which means our models are identifying opportunities in these companies, which is very hard to do from a naked eye. And it is switching the portfolio every 2 months as well to create this alpha and maintain the consistency. Couple of other things that are very important to understand is, this is just a chart of 2006 to 2023 when we have created cash in the portfolio, right? I was telling you guys that cash is basically your antibiotic and you only need to take it in an extreme situation. So cycles like 2008, briefly in 2020, briefly in 2022, 2011. Whenever there is excessive stress in the market, you're better off having cash in your portfolio. If there is no stress in the market at a global level, you should always be fully deployed to equity. Don't try to save 5%, 7%, 8% market corrections. They are a part and parcel of the market. Based on all our backtest for the last 30 years, what we've understood is, every time you try to save a 5-7% correction and go out of the markets, you actually miss a 30-40% rally. So unless there is a very, very large risk in the market, do not try to go out of the markets. And I have innumerous examples of people who probably exited the market in COVID, have still not been able to re-enter because markets keep making new high. And now they are stuck to that bias that we exited at 8,000, how can we enter at 23,000? Or in the last 5 years, the guy who exited at 8,000 could not even enter at 12,000, 13,000. So point is, don't try to time the market or exit it for minor events. If you have an exit philosophy or an exit mechanism that will not only get you out, but also get you in, only then you can make money across cycles. And we use a quant method to do that, which means we are not getting signals only to exit. We are also getting signals to re-enter the market. So beyond a point, we will not be out of the market for too long. Similarly, this is how the portfolio has been in action, right? Large cap, mid cap, small cap mix also has been changing across market cycles. And a dynamic strategy that can make money across cycles needs this facility. Same for style regimes. We look at market in two lenses. First is, what is the fundamental style? Quality, growth or value. There are only 3 dominant styles. Second is, what is the technical style? Are we in a momentum regime? Are we in a low volatility regime? So our models have to detect this and accordingly construct the portfolio and pick stocks. This is how the portfolio changes its color in terms of sector. As I told you, we don't believe in a buy and hold sector approach. We believe in a sector rotation approach. So if you see the changes in the colors, it's very evident that we've rotated sectors through and through. And finally, how much risk we take in which part of the market cycle. Very evident to see that every time markets are in a bullish phase, our beta is more than 1. Every time you see a white zone, markets are in a bear market, our beta is less than 1. Very important to ensure that your portfolio also changes its beta as per this. And finally, all the work that we've done, the process that we've created, the returns that we've generated is because we have a team of very, very specialized people working for us, right? Data scientists, machine learning engineers, risk analysts, fundamental analysts, technical analysts, economists, statisticians, mathematicians. So it's a very, very powerful team. We've obviously got 80 years of experience in the markets. So we've actually leveraged that understanding and converted it into rules, processes, and systems. We've created more than 1,000 plus proprietary market indicators. We've tested 7,500 strategies to shortlist this one, the one that I'm talking about, the Aqua strategy. And finally, we have Dr. Punita Kumar Sinha, who's the chairperson of our asset management and investment committee, and Mrs. Amisha Vora, who's the managing director of chairperson and managing director at the PL group level. And with that, I think I've explained you guys key things. I'm happy to take any questions. Yeah. every week. So the cash model, the macro and market risk model runs every week to create cash. But the stock changes, etc., that happens once in 2 months.
हेलो, अभी आपने जो बताया कि जो री एंट्री आप करते हैं, अभी
हाँ.
करंट सिचुएशन में आपका पोर्टफोलियो ओवरबॉट पोजीशन में है.
हाँ.
अभी 25% आपको री एंट्री करना है, तो हाउ यू डू इट दिस टाइम?
अभी मेरा पोर्टफोलियो फुल्ली मतलब पूरा
सपोज अभी हाइपोथेटिकली अभी आपको 25% आपका स्टॉक है रीबैलेंसिंग करना है ओवरबॉट पोजीशन में. मार्केट इज ऑल द टाइम, तो अभी आपको कोई सेक्टर में चेंज करना है, तो मेरे को आप कैसे स्ट्रेटेजी चेंज करते हैं? हाउ यू आर चेंजिंग द पोर्टफोलियो?
सो एक सेकेंड, आई जस्ट शो यू गाइस हम पोर्टफोलियो कैसे चेंज करते हैं. एक सेकेंड. पहले तो पोर्टफोलियो के जो से 30 स्टॉक का पोर्टफोलियो है, तो मेरा मॉडल ही मुझे दिखाएगा कि ये 5 निकालो और इसको इससे रिप्लेस करो. तो वो आंसर मॉडल से ही आता है. मैं पर्सनली कोई डिसाइड नहीं करता हूँ. ये मैं और मेरी टीम ने 5 साल मेहनत किया ये स्ट्रेटेजी बनाने को.
अभी ओवरबॉट पोजीशन में आपका कोई एक स्टॉक है, सपोज HAL है,
हाँ.
हाईबॉट पोजीशन में है,
तो वो मेरा मॉडल निकाल देगा उसको.
नहीं निकालेंगे, लेकिन नया जो स्टॉक आएगा वो भी हाईबॉट ओवरबॉट पोजीशन में है.
बट ऐसा नहीं होगा ना. अगर एक स्टॉक वैल्यूएशन की वजह से निकाल रहा है तो दूसरा स्टॉक वही उतना ज़्यादा महंगा नहीं होगा.
तो सेक्टर चेंज करेंगे फिर आप?
सेक्टर भी चेंज होता है. मैंने आपको दिखाया ना सेक्टर कैसे चेंज होता है. हम कोई एक स्टॉक पे व्यू ही नहीं लेते. हर 2 महीने में पोर्टफोलियो रीबैलेंस होता है, तो थोड़े स्टॉक अपने आप बुक हो जाते हैं और नए स्टॉक अपने आप आ जाते हैं पोर्टफोलियो में.
थैंक यू.
यस.
So,
सॉरी शी इज. हाँ आप पूछिए.
You have talked about risk management. So my question is, you can mitigate like on systematic risk through diversification. But how can you mitigate systematic risk in your portfolio?
No, so that is what I said. Systematic risk you cannot predict and you cannot mitigate in advance.
But there are few tricks, right? So you can at
Yes.
least mitigate the systematic risk.
Yes. So I'll show you what we do here. So first, if there is a global risk event, we will reduce small caps, shift to large caps. Secondly, we'll reduce the focus on growth and momentum. We'll shift to quality, low volatility. If we have cyclical sectors, we will completely shift to defensive sectors. If we have a high beta portfolio, we'll shift to low beta portfolio. And we will also create cash. All these things are methods to respond to unknown future risks, which you can't predict, but they can happen anytime.
so when you do the rebalancing, right? So is there a time when we have all the stocks from the same sector? Can it happen, or you?
No, that's never happened. It'll always be 5-7 sectors will be there in the portfolio.
Okay.
We could have more weight. So like industrials, like that's the sector we had a 42% weight. But within industrial, we have cap goods, engineering, defense, railways, infrastructure. So there are micro sectors and themes within every sector.
Sir,
Thank you.
Yeah.
sir,
Okay,
What-
guys, I think
sir,
we're
one
done.
last
Okay,
question.
okay, sure.
Sir, what is your take on stress test results SEBI had published in March?
Huh. About for the small and mid cap funds, right?
Yeah, small
I
and
think
mid-cap
most of
funds.
them did fairly well, leaving aside a few. And if that was
small,
a real,
Quant small cap fund, it is written that number of days to liquidate 50% of portfolio, it takes 22 days.
I said except a few, most of them did fairly well.
So what is your take on that? How can we mitigate that risk?
You have to not invest in a fund that has 22 days ka this thing. Simple.
That is obvious. But other than that,
But I'm actually not understanding your question only. How will you mitigate that risk?
Yeah, that is
the
what
fund house has to mitigate that risk.
Acha,
No?
okay.
You just don't invest in that fund. Invest in a fund which has 5 days, 10 days to liquidate 50%.
Okay, so mid cap had smaller number of days, right?
Yeah,
Lesser
move
days.
to flexi, move to multi-cap categories.
Okay.
Change your fund
Okay,
house.
okay.
Don't invest in funds which very illiquid stocks.
How much did PL had?
Sorry?
Stress test result. I am not aware of PL.
No, so we don't have a mutual fund. We
Quant-
run only
quant-
PMS, 50
Okay.
lakh minimum ticket size.
Okay.
Yeah.
Fine. Thank you.
Anything else, guys? I'll have to close. The next speaker is waiting. Yeah? Thank you so much, everyone. Thank you.
Your valuable insights. You shared a very different perspective of the market, how man with machines and not man versus machines can generate alpha for the investors, and how we can trade in various market cycles differently. Thank you, everyone. We'll have 5 minutes tea break now.